Welcome back. Let's get chatting about CreditAccess Grameen. That's surging in trade. The stock is up 6% after what was an operationally strong numbers. The company has seen an improvement in its return ratios as well. To discuss the outlook, we're now joined by Udaya Kumar Hebbar, the MD and CEO of the company. Morning, and thanks so much for joining in. It's a good quarter for you, Mr. Hebbar. Profits too ahead of street expectations. But could we talk a bit about the Madura legacy book? Because you have indicated that you plan to write off a portion about it, which will increase your credit costs in Q4. Some details about this and the way forward.
So we have we have a very small legacy book, which is 8% of Madura book, and on a consolidated, it's just 1.7% of the book, which was little old model, and we are little unable to completely control the cost. That is why, because of that, our total credit cost might go up by about 30 bps. That's the only change. As we guided only 2% cost, probably we'll end up at 2.3 cost because this additional cost we are anticipating. We thought we'll tell this upfront. So in the meantime, this will not impact our ROE. We are able to pass on the credit cost or pass on the pricing. So we are able to price it better so that our ROA and ROA will be intact. That's our guidance on ROA is still intact and ROE is intact. Therefore, it won't impact the bottom line.
So FY23 credit cost guidance has gone up from 2% to 2.3%, a 30 bips increase. For Q4, what could that number look like, and will it impact FY24, either the first half of the year, Q1 FY24, Q2 FY24?
So we guided about 4% ROA for this year, and we will be able to achieve that. That's what our guidance, which means with the 2.3%, probably the credit cost, 4% ROA, 16 to 18% ROE, and about 24-25% growth. This is intact. We'll be able to do that. For FY24, we have to establish, but our aim is to grow in the similar 20-25% growth of growth, and credit cost should come down by 30-40 bips, or it may be around 1.5 to 1.6%. That is what we estimate for the FY23-24. This year, we estimate a little higher because we still had some legacy book at the start of the year, which was impacted because of COVID. Therefore, we estimate a little higher than the next potential year.
Okay.
All right. Good morning, Mr. Hebbar. Thanks for joining us. If I can ask you on the margins that you've seen, it's been pretty flat at around 12%. This is in spite of the fact that your yield has gone up by around 50 bips. I'm guessing on account of higher cost of funds. But can you tell us what is the outlook for the margin? Do you see it expanding materially from this 12% kind of level?
Yeah, there's two important factors here. We were about 12% both quarters, but we had little higher liquidity during the Q3 because we raised a lot of international borrowing and we raised NCD, as you know. All these have impacted little higher carrying cost of the liquidity, which impacted by about 11 bips. Therefore, it looks like it's flat. But our view is that our NIM should be around 12.25% going forward, and which will be stable. So, and which will be quite stable going forward. With increased benefit of price, we will get the full benefit by only entire 2 years' time. As of now, we got more than 50% benefit. The remaining benefit we will get in the next 12 months' time.
Okay, so you're expecting NIMs to climb up and remain above 12% as well. Mr. Hebbar, almost 12.5, got that. Can we talk about business growth itself, and if you can give us some projections, because your new borrower additions have been pretty strong. You added a little over 3 lakh borrowers in this quarter versus about, I think, 2.8 lakhs in the previous one in Q2. So what is the outlook in terms of adding new borrowers and a ballpark estimate of how much you'll grow the book by in FY24? If you can share some estimates with us, that would really help.
So our estimate is to grow between 20 to 25% asset growth and 10 to 12% or even up to 15% customer growth. So we are already in that kind of trajectory, adding more than 100,000 customers every month, which is quite a good and positive in terms of a robust expansion. New branches we added this year. This quarter again we are at 40 branches, and next quarter again we are planning some more branches. So which means with the adding up about 10 to 12% branches, we'll add about 12 to 15% customers and grow between 20 to 25%. This is what our plan, which we have to be finalized by end of the year, but we should be around that range.
Okay, got that. So yeah, that really does help, and perhaps so you're out of time right now. Next time we'll chat about the geographical spread where the business is coming from, whether you're moving beyond some of the key states. But that's a conversation for later. For now, thank you very much for joining in with a quick take on the performance. Stocks doing really well, 6% on CreditAccess as we see it this morning. We'll take a break. On the other side, we will come back with yet another earnings conversation. The management of $1 Holiday will join in.